So Michael Burry, you know, the guy famous for shorting the housing crash the last time it happened. They also call him the Big Short. He also called out the last 30 to 3 recessions. Yeah, that guy right there. Well, he just recently came out and stated that he was dead wrong. He put out a tweet saying, I was wrong to say sell, right? Now, this was pretty admirable coming from him, considering the fact that usually when he's wrong, he just deletes his tweet and moves on. However, you know, I guess there's some maturity over here admitting that he was wrong. Now, I want to go ahead and provide you guys some context. See, Michael Burry tweeted a sell originally back in January. Now, if we take a look at the QQQ, which is the NASDAQ index ETF, we see that prior to January, there was a lot of bleeding going on. Now, why did the market tumble so hard? Well, we entered into a risk-off environment. The Federal Reserve was hiking the federal fund rate at one of the fastest paces they've done in decades, right? And then on top of that, adding another layer to that, you know, during December, we had a lot of tax loss harvesting, where we had individuals like Nancy Pelosi who just have unlimited profits from insider trading, you know, just taking advantage of tax loss harvesting, getting rid of some of the shares that they had that, you know, were unprofitable just to offset all the gains that they had from, you know, insider trading, right? So of course, you know, this looked really bad. However, after, you know, January or during January, we had a really bullish market. Now, right after Michael Burry tweeted about him being wrong, he also tweeted, going back to the 1920s, there has been no buy the frickin' dip generation like you. Congratulations. And then he shares this chart from Bloomberg, right? And it just shows that, you know, pretty much this year is like the second time where we had the most amount of buying the dip. Now, the last time we had so much buying the dip happened back in, you know, 2020, right? You know, during the pandemic, where we had this V-shaped recovery. Now, I'm not trying to bash Michael Burry. I think he's a very intelligent guy. What I want you guys to understand is that you should not just blindly follow any of these talking heads or anyone just blindly, and really just pay attention to the data that's coming in and, you know, just trickling into the market. Now, me personally, I don't think Michael Burry was entirely wrong. I think he's just slightly off on the time, which is really hard. It's very difficult to time the market. That's why it's better to have time in the market, right? That's why you want to have a long-term investing account, right? Just dollar cost average. Now, I know some of you guys may say, but Justin, don't you trade? Yes, I also have a short-term trading account where I do trade on the short term. However, I'm not trying to make predictions of what's going to happen in the future. I pretty much just trade the data that's coming in for the day. And then, of course, you just add risk management, and then boom, that's all you have to do for short-term trading. But in the long-term account, you really don't have to worry about timing. Timing the market, look, it's very difficult. Now, I think Michael Burry, personally, I think he got this wrong. Now, the reason I say this is because, yes, there is a lot of buying the dip happening, especially in these times, right? I think, you know, during the last few years, there's been a lot of financial literacy because of the internet. More people are aware that, you know, when the market goes down, you don't just have to sell and, you know, just get rid of everything. You could just buy the dip. Now, of course, yeah, I think there's just more awareness to that. More people understand that. However, there's going to be a time where you can't buy the dip, right? So when can't you buy the dip? Well, why did we have people buying the dip in the pandemic? Well, there was a bunch of stimulus in the market, right? So of course, people were flush with money. What can they do? Just buy the dip. Very easy. Now, right now, we're in a different time. We don't have stimulus. So how are people buying the dip? Well, if you guys watched my last video, I talked about how employment throughout all the states, I have the chart right here, is showing that employment is increasing. So right now, individuals are not really relying on stimulus money, right? What they're really relying on is that they, you know, there's just a maximum amount of people, you know, just having jobs. So they're not, you know, relying on just extra money, but they have money coming in where they could fund buying the dip. Now, when can we have an event where people can't buy the dip no more, even if they want to? Even if people are aware where they want to buy the dip, but they can't. Well, that's going to happen when, you know, jobs are gone, right? There's no stimulus. And then on top of that, a credit crunch. Now, if you guys watched my last video, I talked about the possibility of a credit crunch going on with, you know, with everything happening in commercial real estate. Now, do I think this is all going to happen pretty soon? Look, I don't have a crystal ball. That's why I'm not here tweeting, sell, buy, I was wrong. I don't do any of that, right? Because again, it's hard to time the market. So with that being said, I can't tell you what month, what week, or what day things are going to reverse. However, what I will say is, I don't believe a soft landing is going to happen. And I want to go ahead and show you some data points and also show you some, you know, interesting things that I think we should be paying attention to. However, before we go ahead and look into that, make sure to go ahead and tap this beautiful subscribe button if you're not subscribed to the channel already. And for those of you guys that are already subscribed to the channel, much appreciated. But with that being said, let's go ahead and cover a few things. So we had Federal Reserve member Collins mention that they have to raise rates again to help lower too high inflation. He also mentions that, the banking sector is strong, resilient, but likely to pull back on lending. Right? And then he also mentions that likely lending cutbacks will restrain economy. So what this is basically saying is, okay, we don't think, a whole bunch of banks are going to, automatically collapse, but, with everything going on, right, everything's tied together. So what's happening in the commercial real estate market, well, that's going to lead to a lot of banks having to cut down on lending, a credit crunch. A credit crunch is going to lead to a lot of Americans and a lot of business owners having a lack of access to credit. And so a bunch of business owners who have credit lines to pay their employees through payroll, they're not going to be able to. And what's that going to do? That's going to hurt jobs, and that's going to hurt spending. And this is going to, bring down, service inflation. So this is kind of what the feds want. They kind of want a credit crunch to happen. On top of that, we also had Federal Reserve member Kasari, right? And I may be pronouncing his name incorrectly. However, he's actually on the board. And what he went on and said is that, particularly the concern is that housing and core service inflation has not come down. And so this means that, there's a lot more work in order to bring service inflation. Now, I know we just had the PCE, numbers come out. However, I want to show you guys the CPI report that came out in February from Wells Fargo, because I think it does a great job at depicting, how things are looking for service and housing inflation. Now, if we pay attention, we can see that energy, travel services, vehicles inflation is all coming down. However, if you pay attention, housing and other services, which makes up 50% or over 50% of the, inflation, is not even budging. So this is a major concern, because this means that the Federal Reserve really only has a few options, right? They either have to hike even higher or more, or they may not cut, but they just leave rates at where they're at. And see, a lot of people aren't thinking how this is really much of a problem, especially if you're looking into the stock market. However, what you have to understand is the federal fund rate, we don't really feel the impact of that immediately. We're just now feeling what, the start of this was back in 2022, back in the summer, right? However, we're gonna feel a lot more pain as we continue into 2023. Okay, so that's something I want you guys to understand. And to conclude, this is the reason why in my long-term portfolio, I'm really only dollar cost averaging into companies like Tesla that have pricing power. See, even if we enter into a recession, while all the other competitors for Tesla, right, they're trying to work towards profitability, right? They're saying, in 2026, like Ford and GM, they're talking about becoming profitable, years later. Tesla's already profitable, right? And so what they can do is really just have this pricing power where they could actually cut prices again, right? And really just hurt their competition and allow Tesla to even thrive further in the EV market. This is why I'm very bullish on Tesla, even if we enter into a recession. In fact, I'm more bullish on Tesla as we enter into a recession, simply because this is really going to help Tesla survive and really put a dent on the competition. This is why, I'm really focused on stocks that have pricing power. Again, it's not only Tesla, but Tesla is really the main one I have in my long-term portfolio. But with that being said, guys, make sure to check out the links in the description of this video. And also, before you go, make sure to watch this next video right over here. And I'll see you guys on that next video. Take care, guys.